Hello and welcome back, traders. In this video, we're going to be performing a top-down price action analysis on the NASDAQ 100. Just before we have a look at the technicals, let's just quickly remind ourselves of the fundamental picture. So right now, the market sentiment is risk off. What does that mean? So during economic uncertainty, risk off means investors start to sell their riskier assets like stocks, crypto, etc., and they start to put their money into safe havens. This obviously causes a decline in those riskier assets and an increase in the safer havens like gold, which is exactly what we're seeing right now. So that is a short-term bearish fundamental here on the Nasdaq. However, with that being said, I am bullish on tech stocks. The Nasdaq obviously tracks the top 100 tech stocks. I am bullish in general on AI and tech. Okay, and we can see that on the chart. So we have short-term bearish fundamentals, long-term bullish fundamentals. Now let's see what the technicals are saying. So 2023 has been a very, very strong year for tech stocks. We've seen this huge push to the upside. We had 5 or 6 multiple consecutive bullish months here on the Nasdaq, and we have pushed all the way back up to 16,000. Now this comes off the back of all these AI surges, these tech stocks surging. Okay, so we've got this beautiful bullish move to the upside here on the Nasdaq. What we can identify in the whole picture is the market is bullish, right? We're forming consecutive higher highs, higher lows. Now recently the markets came down to this level of monthly demand, formed the equal low and started to push to the upside. So I do believe sooner or later the market will take out this high and form a new higher high, which coincides nicely with my long-term bullish bias. However, like I just said, current market sentiment is risk off. Okay, so let's try and align that short-term bearish fundamental with some technicals here. And what I can identify straight away is the market is testing this level of monthly supply. We have monthly supply that created this move to the downside, and although we have formed the higher high, the higher low, and I am expecting a higher high sooner or later, the market is still quite overextended and we are rejecting monthly supply. So, if we take our Fibonacci from the low to the high of the monthly impulsive move, why is this a monthly impulsive move? Because here, during this impulsive move, the market then made the corrective move. Now, inside of the corrective move, the market was making lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Here, the market broke above the previous lower high that pushed the market to the downside. Okay, so this corrective move changed into a continuation move. Now, this continuation move, as I said, we've got the higher high, we've got the impulse leg. Now we are looking at where the market can potentially retrace to. So we have the 0.5 here and the 0.382 Fibonacci retracements that the market can easily come into. What we also have in confluence with the 0.382 is, let's just clean our charts so you can see exactly what I'm referring to. What we have in confluence with the 0.382 and the 50% fib is we've got this beautiful harmonic formation in the pattern of a W. Generally speaking, when the market prints a W formation, a harmonic pattern like this, the market likes to complete the pattern at the neckline, which is quite simply previous resistance, broke to the upside, turned support. So we have the Fibonacci extensions and the W formation neckline here. This will act as a magnet to attract the price to it. So basically what I'm projecting here from a monthly perspective, short-term bearish outlook, further corrective moves into this level of confluence, and then then we will reassess the situation if the market gets here to look for potential longs. Okay, so short-term monthly bearish outlook, long-term bullish outlook. Now, if we drop down to the weekly time frame, what we can identify from a weekly perspective is, as you can see, the markets came into this level of supply and it started to make this weekly bearish trend, this weekly bearish corrective trend. You can see here we've got the high, we've got the low, we've got the lower high, we've got the lower low, we've got the lower high, we've got the lower low. So we are in a weekly bearish corrective trend. So if you have a look at the previous weekly candle, the previous weekly candle closed with a bearish engulfing, right? This candle is the one that I'm referring to. This was last week's candle. We opened with a gap on Monday, then we filled that gap last week. We've taken out these lows, okay? We've got a bearish, strong momentum bearish candle. Now, we have a gap exactly here, right, that the market could easily come up and fill this week and then start to make the moves to the downside. Don't forget, we've got a short-term bearish outlook and we are expecting price to get attracted into this level. What we can also identify from a weekly perspective is we have weekly imbalance in the form of this internal fair value gap. The market during this move to the upside took out the external liquidity residing above these swing highs, the buy side liquidity residing above these swing highs. Once external liquidity gets taken out, okay, i.e. swing highs, the market then targets internal liquidity, i.e. fair value gaps, okay? And that's exactly what's happening right now. So from a weekly perspective, again, we are bearish. We're expecting price to get attracted into this level and the Fibonacci levels. Now, if we drop down to the daily time frame, from a daily perspective, we can clearly see that the market is trending inside of this. Is it a wedge or is it a flag? It's a flag. Okay, the market is trending inside of this bullish flag. Why is this known as a bullish flag? Because we have the impulse leg, which is the pole, then we have the corrective leg, which is the flag, and we do expect a bullish continuation. However, the market likes to make a manipulation before price makes the intended move. So just bringing your memory back to the gold analysis that I've been posting for the last few weeks, gold had a corrective move very similar to the NASDAQ here, but it was in the form of a descending triangle, right? Which you could interpret this as a descending triangle. Now, what happened is the market began to accumulate here. The market began to accumulate here and started to push to the upside. This induced the retail traders, to open longs to anticipate the breakout, right? So as the market starts to push to the upside, more and more traders get induced longs. All this does is create liquidity here, where the market needs to move to fill the institutional orders. So with that being said, this is pretty much what I'm looking for here on the NASDAQ, right? That's pretty much what I'm looking for here on the NASDAQ. With that being said, let's just have a look at, let's have a closer look at the daily time frame here. So let's have a look inside of this flag. Okay, so from a daily perspective, we can see that the market again has printed a harmonic formation, this time in the form of an M. The market likes to complete this pattern at the neckline, which is previous support, current resistance. What we can also see here from a daily perspective is we have this imbalance. From this wick high to this wick low, we have an area of fair value. Okay, and the market can easily come up into that level. Remember that yellow line? That is the gap that we have on a weekly perspective. Okay, that gap aligns perfectly with this daily fair value gap. Now, like I said previously, this is a level of support here which the market is currently testing right there. Okay, the more and more traders that start to buy this support, the more and more liquidity gets generated below, and then the market should make the intended move. So basically, what I'm looking for here on the NASDAQ, I'm going to be waiting for price to come up into, let's just adjust that momentarily. I'm going to be waiting for price to come up into this level of fair value. Once price comes up into this level of fair value, this is where I will be monitoring for potential short opportunities. If the market then follows my projection and takes out this descending trend line and takes out this horizontal level of support, this is when we can reposition ourselves long. So first and foremost, we're waiting for price to come into our our daily point of interest for potential shorts. Then if the market follows my projection nicely, we'll be waiting for the market to come back down into this area of imbalance, tap into the monthly W formation neckline where we can potentially look for longs. So that's my projection here on the NASDAQ. I hope you enjoyed the video. Remember, monthly, weekly, daily, 4-hourly timeframes are the best timeframes for the direction of the market, but we just use these timeframes and then we use the lower timeframes for the entries. Okay, so we will be monitoring the market as it approaches our POI on the lower timeframes for one of our valid entry confirmations. We won't just take the trade as soon as it taps into this zone. We will wait for price to reach the zone, then drop down to the lower timeframes and wait for a confirmation from the price action on the lower timeframes to indicate that our bias should be met. And then again here, if the price reaches my projection, we won't just simply go long here. We will wait for the market on the lower timeframes to switch from a bearish market to a bullish market, and this is where we can be potentially looking for a long. I hope you enjoyed the video, guys. Don't forget to join our free Telegram group. The link's in the bio for free trading education and analysis. Take care, guys. Trade safe. Speak to you all later.